Temperatures may be cooling, but inflation, interest rates, and talk of the Fed are still hot. Why is that? And where do we go from here? We are going to break it all down with the house view for you right here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us today. Leslie Falconio and Jason Draho from the Chief Investment Office are back here with me to break down the latest on the CIO house view. So let's get right into it. Leslie, I want to start with you. We're looking at interest rates on a consistent basis, and they have risen somewhere over like 100 basis points since the middle of July through today. So that is a really fast and rapid rise in such a short amount of time. So what have you seen as the drivers here?
Well, you're right, Anthony. We've gone from about a 372 10-year yield in mid-July to, almost about a 490 right before the payroll report. And there's actually been several variables, and I break this out as into our opinion, like one driver and a lot of passengers. So initially, look, the driver was the fact that obviously we've seen a lot stronger growth than what we anticipated, and I know Jason will get into this as well. But in particular, when we think about how this was ignited by the Fed, and to get into a little bit more detail, when we look at the Fed's June summary of economic projection, they had put a recession off the table at that time, but they still included 100 basis points of easing into 2024. Come September, after a little bit continuously strong data, a much more resilient consumer than expected, they kept their recession off the table, but then they moved 100 basis points of easing to only 50 basis points of easing in 2024. So the market had to readjust. So given the fact the market wasn't really expecting such a hawkish tone by the Fed, as it readjusted, short-end rates had really moved higher. And now that the market is saying, well, if you're going to keep higher for longer, and if I'm going to hold a treasury that I'm going to lock in longer, I need to be compensated for that. So we've had these variables that have come through that in terms of, starting with the Fed, strong growth. And then on top of that, we have things such as supply, quantitative tightening, interest rates rising abroad, a stronger dollar that's keeping, some foreign investors at bay. So there's been sort of like a myriad of variables that have pushed rates higher, but mainly it's been due to stronger than expected growth and a Fed that was a bit more hawkish.
Great, Leslie, thank you very much. Jason, I want to get into the data here because we had most of the data, the economic data for September that is relevant for when looking at the economy has come out. We've seen jobs numbers, we've seen manufacturing data, we've seen inflation through CPI. What is the data telling you? Because it's looking pretty strong. I mean, look at non-farm payroll, 336,000 for the month of September, well above consensus.
So the data collectively is saying the U.S. economy is not really slowing down at all. An interesting statistic, right? From going back into August, the Atlanta Fed has a tracking estimate for GDP. It was around 5%, and everyone else was sort of close to 2%. And there was thought, well, so this is going to come down. What's really happened is as the data's come in, expectations among sort of private sector economists have been moving higher. Those are now like 3.5%, 4%. The latest data we've gotten from September has been like that last kind of bump higher. And it's pretty broad-based. You mentioned like the payrolls report, well above expectations. Retail sales strong, and even the data, if you kind of break it down almost like week by week, it looks like it picked up later in September versus the start, where you might get a little bit of a boost from the back-to-school spending. So not a lot of drop-off there. So the economic activities holding up well. Now, the sort of offset to this sort of overall really good news story is that inflation data was also a little bit harder than expected. If you look at the CPI, PPI data, inflation expectations measures, like the University of Michigan will come out with a survey, that bumped up a little bit. So you take that dynamic plus an economy that doesn't seem to be slowing down that much, there is the concerns, not so much of reacceleration, because it's hard to reaccelerate when you might be growing at 4%, but the slowdown that's been widely expected in the fourth quarter and going forward, I think there's a little bit of questions how much it might slow. So it's good news overall. It's also why when you think about recession risk and our sort of softish landing call, the odds of a recession starting like in the next 12 months, they continue to sort of decline just because the conditions are so robust right now. I think you're seeing even consensus expectations amongst economists that before it was definitely going to happen. They're kind of moving to where the market was in the summer. Now, I think less than 50% are saying a recession starting in the next 12 months, just because the data is like, it's hard to see what would cause a recession, barring some shock. And there's always that risk.
Of course.
But just given the current trends of the U.S. economy, without that kind of shock, then it seems like, well, moderating growth, but, moderating maybe from 3 to 4% to something like closer to 2 or a little bit below trend, but not recessionary levels anytime soon.
Yeah, and just looking at the numbers themselves, math doesn't lie. I mean, you can see just the expansion in the economy based on the labor data and, like you said, manufacturing, retail sales, and all that. So, Leslie, let me bring you back in here because we keep hearing about, I'm sure a lot of investors are talking or hearing about rising term premiums. So let me just ask you, what does it mean in kind of layman's terms, and how meaningful is this to what we're seeing in the move in interest rates?
Listen, a term premium is just in layman's terms what you should be compensated for by locking up your money for a longer period of time. So in other words, it could be the difference between buying a one-year treasury and rolling it 10 times or locking up your money for 10 years. If you're going to lock up your money for 10 years, then you expect to be compensated for that. Historically, because of things such as quantitative easing, investors haven't expected that kind of compensation because the Fed was buying treasuries on a scheduled basis. And since the Fed moved fairly aggressively in rising the Fed funds rate, it was always expected, okay, growth and inflation are going to come down because of that really sharp rise in interest rates. So it stayed fairly tepid. Now, as Jason has mentioned, we've seen this, stronger than expected growth continuously for a period of time. Now investors are starting to take a step back and look, and we're having these other variables that are really getting more headlines that have been around for a long time, such as quantitative tightening. The Fed's been utilizing quantitative tightening for over a year. Supply, the fact that the U.S. has a very large deficit. This has been, the U.S. deficit has been an issue for quite some time. And the August refunding announcement, the amount of supply coming into the marketplace, reported that you're going to have a quarter of about $1 trillion, which was the second highest quarter in history. All these things are actually known prior, but now they're just getting a little bit more headlines because the Fed is higher for longer, number one. Two, as Jason mentioned, the economic numbers continuously are coming above consensus. So we have this strength. So now investors are saying, okay, wait a second, I need to be compensated for this. Because now as we shift and we move towards, okay, if Fed has been one of the largest buyers of U.S. Treasuries, we know they're doing quantitative tightening. The Fed is what we call a price-insensitive buyer. Whether interest rates go up 75 basis points or down 75 basis points, that's not their concern, right? They don't hedge. But now that they've stepped back, we've moved from a price-insensitive buyer to a price-sensitive buyer, whether that is a household, an institutional investor, a hedge fund, a wealth manager. So when that happens is, you take a step back and you become a little bit more opportunistic, and the noise in the system grows. And that's really what we're seeing right now.
Right. Yeah, you really can't. You're looking at that chart, you can't really ignore those premiums that investors are potentially getting here. But that begs the question then, Jason, when you look at the rest of the market and the developments we've seen on the equity side, and obviously the data that we were just talking about, the Fed certainly has an interesting job ahead of them. It seems like they would be smart to kind of keep rates where they are, considering we're still seeing expansion. So what's the story? What do you think is going on?
So the question is, what are they going to do on their next FOMC meeting on November 1st? Do they raise rates or not? So the market right now believes they won't raise rates. Given the economic data that I outlined, it seems like, well, how could they not, given how strong the economy is? But if you look at the overall trajectory of where things are going, the trend is still towards inflation coming down. You can break it down by shelter pieces, that's coming down. Part of the inflation story for September was an uptick in various shelter measures, which is sort of surprising because rents are continue to trend lower. Then you look at the labor market data, really strong jobs number, but what was actually also important is that the average hourly earnings dropped on a year-over-year basis to its lowest level, basically since March of 2021, to about 4.2%. If you take the 3-month annualized increase in average hourly earnings, it was 3.4%. That's bang in line with what the Fed would want to see to be consistent with 2% inflation. So the labor market is softening, it is cooling, it's getting more back into balance. So that would suggest, well, maybe the Fed doesn't have to do another hike based on the data. The second thing is, we go back to Leslie's opening comments about how much rates have moved higher. A higher 10-year yield of 100 basis points in 3 months, that does a lot of tightening that a 25 basis point rate hike won't do. And we've already had a number of Fed officials kind of comment on that. So there's good reason for the Fed to say, well, let's see how this tightening of financial conditions that's occurred just since the beginning of September with higher rates could play out. They only really have 1 month of data. They won't have the October data yet. It's likely that you're going to see some moderation as we go October, November, December, just the impact of those higher rates. So it's likely they kind of skip and then reassess, keep their options open, maybe look at a December hike. The question really to me is whether they hike or not, how does the market interpret it? Are they done if they do hike, or if they don't hike, are they still done because if they didn't hike now, conditions should be even less favorable for a hike in December. So I think that's kind of as important as what they do. How does the market take the news after that meeting?
Terrific. Jason, thank you very much. There's a lot that we have to wait for, obviously, as we go through the rest of the year, but certainly it's good to catch up with you and Leslie on this really important topic of where we're headed. So we'll have more conversations on this. In the meantime, everybody, don't forget to check out all of our content from the Chief Investment Office on our website, ubs.com/views. That is our insights page. Plus, there's a lot more information and content on social media, particularly our Instagram channel at UBS Trending, for studios content that you're not going to find anywhere else. And as always, if you have questions about your portfolio or anything we spoke about today, talk with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone, and remember to keep your eyes on what's trending. See you soon, everybody.